This is a different format today, so we're excited to be able to walk you through this presentation. We're all operating from different sites. So I hope all of our investors are healthy and well. We've got a lot of material to get through this afternoon, so we might make a start, and we'll leave plenty of time at the end for questions. We've been receiving lots of questions via email, so please, should be a link provided. If you'd like us to cover off on one of your questions, please send those through, and we'll try and attend to those. So welcome again. Today's format, moving to slide 3, Tim. Today's format will follow the usual format. In the first instance, we'll talk to the market outlook. I'll walk through the various trends and developments that we're seeing in the financial markets. Then we can walk through the portfolio and take you through some of our key ideas in the portfolio. And Tim then, our Chief Operating Officer, will take you through the updates with regard to the company and the manager, leaving plenty of time for questions. So Tim, maybe then moving on to slide 5, which I think really just captures where we are in this crisis. We've been through bear markets before, and whilst this one has a different flavour, the tenure I would expect to be similar to what we've seen with prior downturns. The recession certainly is as deep as we've seen in previous economic downturns. So there's no reason to expect the duration of this cycle to be any different. And on that basis, as you can see in slide 5, you'd expect that today we are still very, relatively early in this crisis. 2 or 3 months seems like a lifetime for many, particularly if you're out of work. But relative to what we'd normally expect from an economic downturn or from a bear market, we are still relatively very early in this. Principally because of this duration, we have continued to retain conservative settings, which you'll see in a moment. But there are all the prior cycles on display, and if miraculously this economy comes back to life, running at full steam, then we will see a short, sharp cycle, but it will be unprecedented. That's not our expectation. We still think there's plenty of water to run under the bridge here, and it pays to retain cautious settings until the shape of the recovery and the progression of the disease is clearer. Also on slide 5, you can see here, the earnings of public companies through a downturn typically take about 3 years to recover to their prior levels. And that's how the market's valued. The market is valued off profits and earnings. And so if it takes 3 years to get back to where we were, then, by extension, it should take a similar time for the share market to get back to that level. And that's how it's played out in the past. And we would expect it to play out in a similar fashion this time. Obviously, some markets around the world aren't far off their highs, and we think that is too optimistic with regard to how investors are expecting this crisis to develop. That's a very optimistic V-shaped scenario, which we don't really buy into. The next slide, Tim, walks through just a profile of the development of the Spanish flu back in the early part of the 19th century. You can see here with the Spanish flu, we did get a second wave in the US. There was a very different outcome also in the US between the West Coast and the East Coast during that Spanish flu episode. the West Coast communities learnt quickly from the experience in the East Coast and, avoided a lot of the damage done by the second wave. Obviously, this is a question for everyone now as these economies open up again, whether we see a second wave. I've also put in this slide here the number of new cases across the 4 key regions in the US. And we're actually modelling this, and we've got some projections as well, which would suggest that the new cases in the US will actually start to increase again in the coming weeks. The problem they have here, again, it's a mix of regions. A lot of these policies that have been put in place to contain the disease, they are managed at a state level. So you've got to look at every state and how they're dealing with the disease. And if you add all the states up to form regions, you can see, the epicenter of the crisis back in February, March was the Northeast, New York principally, and you can see they now have the disease well contained. The Midwest, again, the new case numbers are falling quite quickly. The problem is you've got many of these other states now that are seeing a significant increase in new cases in the South, in states like Florida and Texas, and in the West, California also is a big problem. So if you add all that up, you can see, the South now, which is booking 10,000 new cases a day, is twice as big, or 5 times as big as the Northeast. If you go back a month ago, the Northeast was 3 times bigger than the South. So, the issue here is one of mix in the US. New cases we would expect to start to increase in the weeks ahead. So, this prospect of a second wave is a real issue, and I think that will potentially undermine confidence. The market is not completely immune to this issue. We've seen recent volatility. Has really emerged as a consequence of this, and some lockdowns in Beijing, which we've read about in the news in recent days. But this prospect of a second wave is a very real and present danger for the markets. So moving to the next slide, Tim. Where to from here? Is this pause in the rally, and will the markets then continue with their rally and retest prior highs, or is this the beginning of or the end of the bear market rally? That's the question everyone's challenged by at the moment. Bulls versus bears. It's pretty clear it's a battle between the real economy on the one side and policymakers on the other side of the ledger, providing unprecedented levels of stimulus. They're the two opposing forces. We are faced with, and just getting the timing right between the stimulus that's coming through and the recovery in the economy. That's obviously very important. The policies are there to create a bridge for households as the economy regathers momentum. We want to make sure that bridge doesn't really appear, and as these stimulus measures roll off, there's no lifeline there for households in need. So time will tell whether or not the timing has worked. The Australian economy is in relatively very good shape. You've seen all the numbers on the progression of the disease. We're in a very fortunate situation versus other countries. So it's good for our economy, good for our markets. Our share market has underperformed global markets. There's some good reasons for that, which we'll take you to. But the disease itself we've had some good outcomes in Australia. The share market outlook, we would expect this heightened volatility to continue in the short term. we're not out of the woods by any means. We've got a long way to go in this crisis. Whilst we're not altogether confident in predicting the outlook in the short term, we are actually more confident with regard to the outlook in the medium term. And we'll move to that in forthcoming slides. But we just think the growth outlook in the medium term has probably stepped down a gear with this crisis. The remedies that have been taken to address this crisis, principally, the additional debt burden to households and to the public sector, ultimately will weigh on growth in future years, and we'll take you through that in some of the slides to come. Tim, moving to slide 8. Again, the size and scale of the stimulus here is unprecedented. I lived through the financial crisis, or managed a portfolio through the financial crisis, and it was a long period before the policy measures were put in place to try and counter the downturn that we saw, particularly in the financial sector. The bailouts and so the stimulus measures were really 18 months before we saw those. In this case, what was so unusual about this crisis is the stimulus was very early. As an analogy, the ambulance turned up before we even sailed off the cliff, and so that was definitely a benefit. And they've really oversized the stimulus. You can see here total stimulus 18% of GDP globally. This is an order of magnitude higher than the stimulus we saw in the financial crisis. So again, balancing the depth of the downturn with the size of the stimulus, whether they've got that mix right, is the big question. If you look at the next slide, you can see household income has actually benefited significantly from this stimulus. Household income is actually will be up 12% this quarter. And these are all the benefits that are coming through. And we'll show you in a moment where a lot of that money's going. It's not going into building roads and bridges. A lot of it's going into poker machines and gambling, which is not ideal in terms of creating future growth. But the money has got into households' pockets very quickly. And it's actually proven to be a bonanza for some segments of the retail sector. And we'll take you through that. Moving to the next slide, Tim. So where are we today with this? We've moved into a new era where markets are increasingly dependent on the continuing support from policymakers by way of monetary stimulus and potentially fiscal stimulus. If we need to see more fiscal stimulus to create this bridge to a stronger economy. Governments have become spenders of last resort. The largesse here is unprecedented, and we can just see that in the price slide on household spending, and a lot of that money is being wasted. This ultimately creates a big problem for the future. It contributes to the debt imbalances both in the private and public sector, which at some stage have to be addressed. The risk is we end up in a debt deflation trap, which combined with secular stagnation, these trends that have been in place for many years now, this leads us to a period of much lower growth, and that's our base case, and that's that gives us confidence in our medium-term view of slower growth. So turning to the next slide, whilst it's difficult to predict the trends in the short term, we can at least provide you with the two bookends, and time will tell where we land between those two bookends. One bookend, a very favourable outcome. The economy responds very well to the stimulus. Everyone gets back to, and the stimulus is not just the fiscal stimulus and the liquidity support from monetary policy, but also you've got low interest rate, very low oil prices as well. So there's a lot of stimulus out there. If that's enough for the economy to recover quickly, everyone gets back to work, the economy recovers quickly, then we have this V-shaped recovery, and the recovery in the share market has been warranted. The other bookend, we have we get recurring outbreaks. They don't have a vaccine for some time, and the disease just keeps creating issues for the global economy. And the issues really are just the disruption that it creates. And we'll move to the profit outlook later in the presentation. But, if you think about where these companies were operating back in 2019, we had full employment. You had companies operating at peak activity. Productivity was very high. And that was reflected in very high profit margins and, very profitable corporate sector. The problem is if you get recurring outbreaks and the disease just continues to linger and create problems, it's the disruption that it creates. The poor productivity outcomes you end up with as no one can return to the office. Not everyone can return to the office. You have the A teams and the B teams, the red teams and the blue teams, and you just can't get companies operate and the economy operating back at its most efficient level. And so it's really that disruption that creates the issue. And how much of a disruption you get from subsequent waves, if they happen, only time will tell. But again, we are probably more cautious on the time frame for a vaccine for a whole bunch of reasons. I think that's one of the misconceptions that has been put out there, that we can expect a vaccine in short order. Vaccines typically take many years to develop for these types of viruses. Take HIV as an example, or Ebola, or even SARS. It takes many years to develop these vaccines. So, in the absence of a vaccine, the disruption from this disease will continue. How much disruption, how we manage that, are the key issues. But that's the disease. And if that does happen, then the households will need more and more support to build this bridge. The bridge ends up being longer and longer, and that ultimately creates a big burden for governments, as they've got to be funded, these support programs, and you've seen significant balance sheet deterioration here in the public sector. That'll only get worse the longer it lasts. Unemployment stays high. We speak to the strategists offshore. The last two recoveries were jobless recoveries. We wouldn't expect any change here. Particularly in the US, they tend to let people go very quickly in a downturn, and then it always takes some time to re-employ those people. So we would expect a slow jobless recovery, and that's obviously not good for household income and spending. And so if we do have this slow jobless recovery, then again the recovery in spending and activity will take longer. And so the other bookend is we end up with very weak growth, stagnant economic environment requiring ongoing support from the public sector. Debt spirals to much higher levels. The debt load has increased significantly with the stimulus we've already seen for this crisis. It can only, if you keep increasing debt balances at this rate, then debt sustainability quickly becomes an issue. We've seen this in Japan and Europe. You've got very, very low growth and large debt imbalances. And this creates a problem for future growth. Turning to slide 12, you can see here what's happened in recent months. And I kind of think of it as a hiatus period, or the eye of the storm. The two main drivers for this crisis, obviously the health side of things, and then the economy. And we're in a hiatus period where you won't know how the health condition or the health crisis develops until, these economies, we're further into the opening up of these economies, and, transmission rates are clearer, and whether we get recurrence is clearer. And we're still too early to see that, although we shared with you the numbers in the US. Some countries you will see that earlier than others. But, we really, and we'll know more about that in coming weeks and potentially months. But we have been through this hiatus period whilst we've been in lockdown. The disease has been contained. Now, as the communities open up again, then the disease could potentially become a big issue again. So that's, and then the other key driver, obviously, is the economy. And the shape of the economic recovery. You've heard all the acronyms: V-shape, W-shape, L-shape, etc. But again, we've been in this hiatus period where you won't know what the shape of the recovery looks like for months to come, potentially as late as August, September. Then, as the economy is further into this recovery, we'll get a sense of what the recovery looks like versus expectations. At the moment, all we can say is activity this month is definitely better than last month, but we don't really have a sense of what the recovery looks like versus expectations. And as the markets have rallied, they start to price in a stronger recovery. And so, the US market, not far off its highs, is clearly pricing in a very strong recovery now. And the onus now is on the economy to recover strongly. If it doesn't, then investors will be disappointed and potentially shares start to fall again. So, we've been in this hiatus period. We're coming out of that now. So I think, and you will start to get a lot more information on the progression of the disease. And so that's something to look out for. And, we've seen a few little wobbles in recent days. And so, that's something we need to really return the focus back to the disease now. And then on the economy, you'll start to get more information on the shape of the recovery, in the weeks and months ahead. So, Tim, maybe to the next slide. So this is some data we've pulled together looking at the last two business cycles. And what you've seen with each successive cycle, the rate of, or the trend rate of growth has slowed. And then there are many reasons for that. In the post-financial crisis period, I'm sure those of you who read the financial literature would have read many times about the secular slowing that we've seen, the secular stagnation that's been talked about. And, there are many aspects to this, but principally it's to do with demographics and kind of debt burdens in these Western economies. But, in the Western economies, you've definitely seen this slowing. And they are largely secular trends to do with demographics and deflation. And you can see here in this slide on 13, the slowing in the post-financial crisis, or the post-dot-com period. The growth was, nominal growth was growing around 7%. Post-financial crisis, nominal growth was just 5%. Real growth was 2.5%. And EPS growth, for that matter, was 2 to 3%. And so with each subsequent business cycle, we've seen a step down in underlying growth. And we would expect that to continue with this cycle. So we think with this cycle, again, because of this structural slowing that continues, complicated further by the policy measures that have been taken to address that structural slowing, which is really the unprecedented quantum of monetary policy support, very low interest rates, accumulation of debt. Those two in combination, those two factors, I think, lock us into a period of lower growth again in this next cycle. And so that's why I have this a confidence in the medium-term view of a slower growth trajectory. But again, the short-term view is much more clouded. Looking at the next slide, what does this mean for earnings estimates and for profits? You can see here for the ASX industrial companies, profit expectations have fallen very sharply. We're down 20-25% as investors and analysts have started to factor in the extent of the decline in activity. But the share market obviously has been pretty strong. I'm not sure this chart has been updated actually, but we're much closer to the February highs. But earnings obviously down 20-25%. What does that mean? If you look at the value of the market in traditional valuation metrics like PEs and so forth, the market's a lot more expensive than it was back in February. Because earnings have fallen so far and the price is only 15-20% off prior highs, then the PE has gone up. And so the market today is on 23-24 times earnings, which is expensive. If you look at the next slide here, looking at some of the earnings estimates that are in the market, these are UBS's estimates. You can for the ASX 200 companies, you can see the earnings estimates have been pulled right back. Actually, there's an interesting observation to make here. Just looking at the history, you can see the earnings growth through the last cycle was very muted. From bottom to top, EPS growth was only 2-3%, which was that prior slide that I showed you. And so we've had very little earnings growth through this last cycle. Again, it reflects the weak growth trends that we saw in the post-GFC environment. All the balance sheet repair that needed to happen post the financial crisis. That was a weight on the rate of growth or the speed of the recovery. And that's why it took so long for the market to recover as well. I mean, we only just got back to the pre-GFC highs in the share market. And that's because the earnings recovery was so slow and so muted. And so you can see that here, and you can see in the red bars, the earnings estimates, for the next couple of years, and UBS expect the earnings to get back to where they were over a 3-year time horizon. So it'll take 3 years again for profits to get back to where they were. So it's a reasonable expectation that it should take, a similar time frame for the share market to get back to where it was previously. Now, we thought the market was very expensive, by the way, back in 2019, before the crisis. Again, the industrial companies were trading on multiples of 23-24 times back in January, February, which on a historic basis is very expensive. And left markets very vulnerable to this sort of exogenous shock with the health crisis. So it's reasonable to assume that it takes 2 to 3 years for the share market to get back to where it was. That's not a bad expectation. Dividends. Now, these are UBS's forecasts as well. Australian companies have been paying out a disproportionately large portion of their earnings as dividends. The payout ratio in Australia, I think, has moved well into the 80s, and that's somewhat unsustainable. So, with this weak profit growth, companies have been increasing their payout ratios to deliver, a stronger earnings growth. So, if you compare this chart with the prior chart, you'll see that dividends actually have been growing faster than earnings. And that's because companies have been increasing their payout ratio. So that's unsustainable. You can't do that forever. And then ultimately this creates a problem for Australian companies insofar as they're paying out more and more of their earnings and reinvesting less. And that means future growth will be lower because they're investing less for future growth. And so, again, it just kind of brings us back to this thesis of softer growth in the medium term. Turning to slide 17. Slide 17, you can see here this is showing the relationship between the S&P 500 group of companies, which is the blue line, and the underlying earnings trend of those companies. So the S&P 500 companies had earnings before the crisis, I think, of 161, I think was the number in 2019. And estimates today are sitting around, closer to 125, 130. So we've had that 25% fall in earnings estimates. And again, we'd expect it to take 2 or 3 years for those earnings to recover. And so it's reasonable to expect that the market would take 2 or 3 years to get back to that prior high. Now, this slide is interesting also insofar as in the bottom panel, you can see here the history of profit margins over time. And, the US companies really were operating at a very high level of efficiency. After 10 years of continuous expansion, you recall that price cycle was one of the longest in the modern era. Again, each year companies were getting more and more efficient. Operating rates were getting higher and higher. At the same time, companies had been investing less than they had in previous cycles. They were paying out more in dividends and buybacks, levering up their balance sheets. So, you're operating a very high level of efficiency, and they're sweating the asset base and distributing as much as they could to shareholders. And that left us with margins at very, very high levels. And margins, you can see, were roughly 50% above their average over the last 10 years. And that just reflects where you were in the cycle. You're at the end of the cycle, profitability was as good as it gets. And that's where the 3-year recovery period comes from as well. It's just going to take a long time for businesses to get back to that level of operating efficiency. And again, the disease will play a role here. If you think about the new environment we're in, a lot of disruption, a lot of additional costs, compliance costs and the like in dealing with the disease. And so it's just going to take a long time for companies to get back to that very high level of efficiency. And so, we think it probably takes longer than people expect to get back to those sort of peak margins. But that's the starting point for your profitability, those very high margins. And, it probably takes at least 3 years to get back there. Last cycle, it took 10 years to get margins to that level. Just looking at the next slide, Tim. So, one of the other features of this recovery, or this recent rally, which has been a surprise to many, has been the strength in the growth sector, or the growth part of the market. And this has played out very clearly in the US market, where growth is a very big part of the US market. The large tech companies, tech and healthcare and communication services, is roughly half of the US market. And so those companies have performed extremely well. The NASDAQ, we'll show you in a moment, is back at an all-time high. So technically, you've been in a bull market right through this for the growth parts of the market. So this chart here tries to we'll walk you through why this is happening and why these growth companies have been performing so well, and it's really to do with valuation, how you value growth companies. But thematically, it's easy to understand. In a low growth environment, you're going to pay a lot more for growth. Companies that are growing quickly, you'll pay proportionately more for those companies. And you can see this also in the way it's playing out in the bond market. And that's what this chart is showing you here. So this is a series that looks at a basket of US Treasury bonds, and this is the price. You can see prices have been rallying now for a good 20, 30 years. In fact, we've been in this incredible bull market in bonds as yields have stepped lower and lower and prices have rallied. The policy support through quantitative easing has been a big part of this. But, we're in this massive bull market in bonds, and we're really in the blow-off phase of this. The last time I saw a chart like this was the dot-com boom, when all the tech stocks were running hard. But this has been the key support of the outperformance of growth names. If you look at the next slide here, you can see the relative performance of growth versus value, which is the blue line, and that prior chart which I showed you, which is the bond price. And so you can see as bond prices have rallied, growth has outperformed value, and with this blow off in bond prices that we've seen, value has really rallied hard. Sorry, growth has really rallied hard versus value. So this has been an important driver of the share market through this rally in recent months, and this has been a thematic that's been playing out for years. If you go to the next slide, Tim, it explains a lot of the difference or divergence in performance between different share markets. You can see here the NASDAQ 100, which is the orange line at the top, again is at an all-time high. Again, the sell-off in February, March was just a correction. In an ongoing rising trend. This market is still very much in a bull market. There's no question there about a bear market rally. The other markets here, you can see what have we got? We've got the developed world ex-US, which is the purple line. So these are all the developed markets outside of the US. And you can see the Australian share market, which is the grey line, has performed more in line with the trends ex-US. We've clearly underperformed the NASDAQ. The strength of the NASDAQ has been explained fully by those growth stocks and the re-rate we've seen in those growth stocks. So the big tech behemoths, the Microsofts, the Googles, the Facebooks, the Amazons, there's been no deterioration in their profit trends, by the way, through this sell-off or through this crisis. No downward revisions to their earnings estimates. In fact, companies like Amazon have really benefited from the crisis. So that fully explains why the tech sector, growth sectors have performed so well. And you can see the US market, which I don't think we have here, has outperformed all the other benchmarks. I think today it's less than 10% off its high, but it's February high. But that's been fully explained again by the strength of the growth parts of that market. The other markets in the other advanced economies, the purple line, haven't performed as well, and that's because they don't have the same exposure to growth. We don't have the big technology sectors that they have in the US. And we have a bigger exposure to more traditional value segments, value and cyclical segments, like the banks and mining companies. And I've put in here also the mining index, which is the green line. You can see again that hasn't performed particularly well. The banks, which have shown some life recently, again they're the big segments in the Australian market, mining and the banks. And these sectors really aren't growing at all. And the banks are challenged. I'm sure you're aware of that. And mining companies, again, they are really deep cyclical businesses. And if you think that their growth outlook is still very soft, then mining companies aren't going to be doing particularly well. So, like Europe, Australia tends to have a much bigger exposure to the cyclical and value parts of the market, and so we've significantly underperformed the growthier US indices. So I'll just quickly now move through some of the key portfolio positions just to give you a flavour of what some of the current themes are in the portfolio. So Tim, maybe moving to slide 23, that's right, the consumer segment. We've shown you already the one-off benefits from the stimulus package that households have received. And you can see that here also in the top right-hand chart. So spending across the tills in Australia, this is data from Tyro, that do all the EFTPOS terminals. So spending is actually up now year on year, which is quite extraordinary when you compare that back to April when we're down 40% year on year. So spending across the tills now is up year on year, which is a real surprise, I think, to many. A lot of this money has been wasted. Gambling, alcohol, car parts. Not a lot of it has gone into future investment. So that's disappointing. It's whether this is sustainable as well, whether this quantum of stimulus or support can be maintained. The stimulus hasn't actually peaked yet. the stimulus will probably peak in the third quarter. So, these trends are actually improving for companies like JB Hi-Fi and Supercheap and the like. So we get to September, though, and who knows what happens then. If you move to the next slide, Tim, you can see the spending peaks in September, $100 billion, JobKeeper's most of it, in the top right. And then what happens? You can see by December it's all gone. So this is going to get very hard for companies to, start to cycle these numbers when we roll forward 6 to 12 months. So when we're looking at these retail businesses, we really need to focus on the outlook for next year. They're clearly having a bonanza at the moment, many of them. Looking at the different consumer segments, again, consumer discretionary, I'd be very careful with shares in that part of the market now. Many of them are back to their all-time highs, but they're benefiting from these one-off stimulus measures, and that's not really sustainable going forward. And again, we're cautious on the outlook for 2021. We think the recovery will be long and tiresome. The consumer defensive parts of the market look a bit more interesting, particularly given the strong rotation we've seen into these cyclical parts of the market. So everyone's gone and chased the likes of JB Hi-Fi and Supercheap, trying to capture some of this benefit from the stimulus. And they've funded that by selling these defensive stocks like Woolworths and Coke and the like, Metcash. We think there's some very good stories around Coke and Metcash in particular. Coke has suffered as the food service industry shut down. They sell obviously a lot of premix drinks, across in restaurants in the food service sector, and have suffered through the shutdown. Not to mention, entertainment venues and the like. And that business will come back as the economy opens up. So we think that Coke is very interesting here, and Metcash we really like as well. The community supermarket really is getting a second lease of life. No one likes to go to be seen in the Woolworths with their slippers on, but if you dare to leave the house, then going down to your local IGA has become a favourite, and Metcash is certainly seeing a benefit there of improved foot traffic. In the growth segment, again, more recently, the bonds have gone into a bit of a consolidation, and growth has been underperforming in recent weeks. And we've seen some of the cyclicals and value segments of the market find some new friends, and growth has underperformed. So part of the consumer growth segments particularly have underperformed, and some of the names we'd like there are IDP Education and Freedom Foods. Just turning to financials, this is obviously a very big part of the share market. The Australian banks represent, close to 25% of the Australian share market. They've obviously performed well in recent weeks, as we've seen this big rotation out of growth into value, as the bonds are consolidated. But they're a long way from out of the woods, that's for sure. The bad debt experience that these banks will see in the year ahead is unclear. With all the deferrals on mortgage payments and credit cards and business loans, we're not getting a clear picture of the bad debt experience. But as those payment holidays roll off, then we would expect the non-accruals to really increase significantly. And you can see here in the top right-hand chart, you can see the bad and doubtful debts provisions, or the expectation of bad and doubtful debts, which is the yellow bar, versus the unemployment rate, which is the orange line. So today, unemployment's over 10%, and you can see historically when we've been at that level, back in the early 90s, the non-performing loans have been much, much higher than what the investment community is expecting from the banks. So, there's a long way to go with these banks. The bad debt experience, we think, is probably going to be a lot worse than the analysts have factored into their models. And then more recently, with the banks having rallied strongly in recent weeks, the valuations aren't looking as attractive as they were, just a couple of weeks ago. So we're back above book value for the banks. So we'd be cautious on the banks, given the move that we're seeing there. Sezzle is a company we like in the buy now, pay later space. They've got over 1 million customers. You would have heard of Afterpay. Afterpay is a $14 billion company. This is a $600 million company. It's got 20% of the customers that Afterpay has, but it's a fraction of the price when you look at what you're paying per customer. They're off to a great start in the US. They've got a great management team, and this is a really exciting segment. So we think there's a good chance that Sezzle can grow to be of a similar size to Afterpay in due course. But we don't think Sezzle will be around as a public company in the years to come. I'm sure someone will snap it up. The incumbents in the US, the credit card companies and the store card acceptance companies, would be looking very closely at the emerging buy now, pay later providers like Sezzle. So that's a name to keep an eye on. In resources, just giving you a quick snapshot of the different commodities and the outlook here. COVID-19 has created some severe supply issues, disruptions, particularly in Brazil, which is a big source of iron ore, but also the demand destruction. And we've seen that play out in oil in particular. Oil as a commodity is far more exposed to advanced economies. And as these advanced economies have gone to shutdown, then oil demand has plummeted. And because there's limited storage with oil, inventories have blown right out and the oil price has collapsed. You've seen that play out in the oil price, in oil markets. We think it'll be some time before the oil price can kind of recover to where it was. And so again, the demand picture for oil looks uncertain, and you need to see a lot of supply come out of the market for the oil price or the oil market to bounce again, and for the oil price to move higher. Iron ore has been very strong. Brazil had its issues with the dam wall failures, and now COVID-19 is a huge issue for Brazil. They've got more cases now than the US, and Brazil produces a third of the world's iron ore. So that's creating another leg up for iron ore prices, which is a great bonanza for the Australian iron ore sector and for the Australian coffers as well, by the way. This is an important source of royalty income for the Australian government, so it helps to pay for all those stimulus measures. Copper, again, we've seen ongoing disruptions there, particularly in Latin America, and that's an ongoing support for the copper price. Oz Minerals is one of the companies that we like in that sector. Aluminium, again, this is a classic smelting sector. China just keeps building capacity. We would avoid investment in that sector. Thermal coal, again, it's another avoid. The Russians are emerging as a big player here. Investors are steering clear of coal for ESG purposes, but also because of the very poor cash flows. The coal price continues to fall, and there's no sign of any rebalancing occurring in the coal sector. Oil, again, we've talked about the outlook for the oil price. Cenex is an emerging gas play, which we like. They have a great future, and the stock's really cheap. So I'd look at that one. And then in the gold space, we continue to be bullish on gold. We're not alone. The whole world's bullish gold. Again, it's tied into what's happening with with money supply and the unusual liquidity measures being taken by central banks around the world. That's what's driving bond yields lower, bond prices higher, and gold's caught up in that same thematic. So long as they keep printing money and debasing the value of fiat currencies, then the value of gold, where the supply is limited as an alternate currency, just keeps increasing. So, and it's interesting, through this consolidation in the bonds, the gold price has held together very well. Again, when this consolidation in bonds runs its course, there's probably another big leg up in the gold price. Yeah, Saracen and Newcrest are the two names that we like there. Moving on to healthcare, Integral Diagnostics is a small company we talked about at our last presentation. Not a lot's changed there. The business continues to perform very well. We've got some good structural growth here. In these imaging modalities that they're engaged in, MRIs, PETs, CTs. The utilisation of these modalities in Australia is quite low because they limit the number of licences versus other advanced economies, and we think that gap will close over time. So there's good structural growth here in this business, and the stock's attractively priced. And just finishing off with the TMT sector, technology, media and telecommunications. We've talked already to tech and how well it's performed. There's a copy of the price slide. Here you can see again this growth thematic and the re-rating of growth. We think will continue so long as these bond prices keep inflating. Who knows when the central banks will stop buying bonds, but so long as they're there buying bonds with their ears pinned back, value of the bonds will go higher, and growth and technology in particular will lead these markets. We really like Xero. It's a leader in the cloud accounting software space. They continue to build their customer base. Everyone's working from home using Xero software. They're a beneficiary of this environment we find ourselves in. Media is the more traditional cyclical part of the market. Again, the cyclicals are in favour at the moment. They're performing well, but at some stage, I think you want to be more cautious on these cyclical sectors. Media is no different. Media, at least, has benefits from the structural shift to outdoor, so it's got some good structural semantics there. The balance sheet now is in much better shape. They raised some money in recent months at 53 cents. We participated, and the shares have performed very well since then. In telecom, again, this is a defensive part of the market. The telecom service providers are doing well. They've done a fantastic job keeping everyone connected through this health crisis, and their benefits are their businesses are really performing well. Again, we quite like this space. Telstra and TPG, following the Vodafone merger, are our preferred plays there. So that's my presentation. Just a quick summary. We are cautious on the outlook. The stronger this rally in shares, I think the more cautious you should become. There's a long way to go in this health crisis. A lot of unknowns that will become clearer, I think, in the weeks ahead. We've had the easy gains. We've been in this information vacuum, and the natural tendency has been for markets to move higher. But now, as more information starts to come out on the development of the disease and the economy, then I think that's pause. That will be a pause for the advance, and then depending on how that plays out, the market will either continue to rally if it's all favourable, or potentially the end of this bear market rally if the information is less favourable. So time will tell. So I might hand over now to Tim to take you through some of the updates on how the business has developed at Watermark, and some of the changes at ALS. Thanks, Tim.
Thanks, Justin, and good afternoon, everyone. So clearly from Justin's part of the presentation, you'll get a sense that there's a lot to keep us busy at the moment and a lot to keep the guys on their toes in terms of developments in markets and so forth. Fortunately, from the business point of view, most of the changes that we've been through as a business were finished and complete back at the start of 2019. So the last 12 or 18 months has really been a period of settling in and development in the team that we've put together. And I think, we can certainly be thankful that those changes are all well and truly behind us when these recent events the events of recent months fell upon us, because certainly there's a lot to think about and a lot to manage. And so the fact that we've got a stable team and a successful process has stood us in good stead. I think if you hark back to 2018, when we went through, I guess, the prelude to this shock for markets, it was the complete opposite situation for Watermark as a business. We were right at the peak of complexity in our business. We were running 9 funds, 3 strategies, covering a global universe of stocks, and trying to keep a hold of all that whilst things are unraveling is a huge challenge. And we struggled like many in that period and had a small drawdown. I think the results that we've seen through this last setback for markets have been a lot more positive for the business. We've managed to protect investors' capital. The funds are doing exactly what they should do, and now it's really a chance for us to move forward and to start putting some strong runs on the board as we try to pick through some of the themes and trends that Justin's mentioned so far in the presentation. So in terms of what the business looks like today, certainly much more streamlined, much more focused. We're down to 2 core strategies, which I'll talk to in a bit more detail, 3 funds, and a single focus on the local share market. And for us, that's meant that we've got more resources and more experience covering the local market than we ever have. So we certainly feel like we're very well resourced. And it's also allowed us to get back to some of the parts of the market that have historically been very successful for us, particularly in the mid and small cap parts of the market, which really we disengaged with to an extent when we were trying to tackle this global challenge. By simplifying the universe and bringing it back to the local market, we've been able to get back in the weeds in that part of the market, and certainly there's been some good successes so far in the 2020 financial year. From an operational point of view, again, we've been very fortunate in the financial services sector, and particularly in our business, that we've been able to handle the operational challenges of the COVID-19 pandemic without too much problem at all. Our analysts and staff all transitioned quickly to remote working. When the lockdowns hit, all of the critical systems and processes, operated seamlessly through that period. And really, I don't think we've missed a beat in terms of our coverage of the share market and managing the portfolios. Obviously, now we'll start to look to transition back to more centralised working and get back to business as usual. And in terms of the strategies itself, I think whilst there's certainly been some challenges for us over the last couple of months, just trying to get our settings right. We feel very positive about the period ahead, and certainly in terms of the strategies that we run and the tools that we have at our disposal to be able to not only protect our investors from some of the risks that are clearly still out there, but really to deliver very attractive returns for our investors. We've been struggling for a number of years in probably the most challenging conditions for a long-short manager that specialises in low net or zero beta strategies. This grinding bull market that we've been in for the last few years, really is the least favourable conditions for a manager such as ours. And so, the volatility that we're seeing at the moment and some of the uncertainty that lies ahead, I think plays to our strengths. And we're looking forward to, as I said, putting some strong runs on the board for our investors in the coming months and years. We had very cautious settings across all the funds when the crisis hit. Obviously, for some time, we got off the bus several years ago in terms of our exposure to this bull market. And so, we were well positioned for the crisis when it hit. I think, Justin would agree that it certainly took us and most of the market by surprise, the severity and speed at which markets fell in February and March. And again, it's taken people by surprise, and really it's presented a big conundrum how quickly markets have bounced back since then. But from our point of view, the cautious settings that we held going into the crisis, stood us in good stead, and we were able to more or less protect the capital that we manage on behalf of investors through that first few weeks of the crisis. The other important development in our business has really just been, continuing to enhance our process and our risk controls. We did a lot of work on that last year. We alluded to that at presentations that we made to shareholders and investors in 2019. The catalyst for that really was the last setback from markets in 2018. We found through that period that some of the tools that we have to monitor risk and exposures in our portfolio probably weren't giving us the clearest signals, and so we did a lot of work and embarked on quite a large project to enhance those tools in 2019. Those were all in place by the end of last year, and so we're certainly much better equipped to understand what was going on and where the risks were in our portfolio. Even with that additional visibility, you always find you stress test your portfolio when you have such a savage move in markets, and so we've continued to try and make sure that we're on top of all the moving parts in the portfolio and develop some additional tools to help us monitor the exposure to all that, but also just to make sure that we're not too anchored in our views in terms of where the market might go from here. We certainly don't want to be fighting the tape if this bull market rally or bear market rally, whatever it is, continues. And so we'll continue to keep developing and enhancing our process to make sure that we're fully equipped to deal with whatever the markets throw at us. I thought I'd just spend a couple of moments talking in a bit more detail about each of the strategies, because one of the common questions that we get, and I think one of the areas for confusion for our investors, is what the differences are between ALF and the Watermark Absolute Return Fund, which are directional long-short funds, or what's also called variable beta strategies, and our market neutral fund. And it is true to say that those two strategies have looked very similar in recent years, and there's good reasons for that, which I'll take you through on the next slide. But just to restate exactly what it is we're trying to do with each of these two strategies. The objective with a directional long-short fund, like the ones that we run, and within the spectrum of long-short funds, ours is probably towards the more conservative end. So we variable beta or low net variable beta strategies tend to run lower exposure to the share market on average. And so what we're trying to do is deliver an appealing return, double-digit returns, but with a strong focus on capital preservation. And so we want to fully utilise the tools that we have at our disposal to make sure that we are fully protecting our shareholders from loss in the case of a setback for markets. The way we make money is by picking stocks primarily, and that will always be the engine room for the funds that we manage. We can also add some additional value through tilts in certain sectors by being long or short in different sectors where we have a fundamental view on the outlook for those sectors. And the third lever that we have to pull in a directional fund is the beta or market exposure in the fund. ALF has a mandate, or ALF and Watermark Absolute Return Fund for that matter, have a mandate that allow us to be up to 100% long, fully invested, and up to 100% short, depending on our view of the market. And so, we fully intend to exploit that ability with the funds to take on exposure to the market and be, up to 30, 40, 50, 60% invested if we see an opportunity supported by valuations and the outlook that we have for the share market. But similarly, when we think that risks are elevated, and in line with that capital preservation mantra, we want to take that risk off the table, and we think we can do that by employing our hedging strategies without compromising completely our ability to deliver an attractive return. The volatility of the fund should be less than the share market, but it's certainly not going to be, sort of significantly less. And so we're prepared with these directional funds to take on some more volatility. And as I mentioned, the net exposure settings will be a function of the market valuation, whether we think the market overall is cheap or expensive, and the macroeconomic backdrop. Do we think that the outlook for the share market is positive or negative? Do we think that it's looking risky, or are we opportunistic? And so, what that means is that where we see an alignment between our fundamental view and where there's valuation support, then ALF and the Absolute Return Fund can be fully invested, 100% long. In fact, they can be beyond. We could go to a leveraged position, similar to what an active extension fund might do, if those, those stars are all aligned. And I think that's one of the things that people may have forgotten or haven't had experience with if they've been on board with our directional funds over the last few years, because our settings have been much more conservative. With a market neutral strategy, on the other hand, the objective here is to deliver attractive returns. We're talking, sort of mid to high single digit returns, but with significantly less volatility than the market. And the returns that this strategy should generate should be completely uncorrelated with the market. So we're looking for a correlation with the share market of zero, or in fact for our fund, at times we've had a negative correlation with the market. And so whilst at times the strategies will look very similar, they do actually have very different risk reward profiles. And again, the way that we make money from market neutral strategies is again subtly different from what we're doing with the directional funds. In a market neutral strategy, if you're fully hedged with a dollar long and a dollar short at all times, the return that you receive is simply the spread in performance between the long and the short portfolio. And so again, the way that we approach market neutral investing, is subtly different from what we're doing with a directional fund. We run very tight cash controls in the market neutral strategy. So again, within the arena of market neutral peers that we have here in Australia and around the world, we run very tight risk settings. Plus or minus 10% are the maximum and minimum net exposure. So that fund will always be, fairly close to fully hedged at all times. And so, again, one of the questions we often get is, shouldn't an equity market neutral fund do well in a falling market? Well, absolutely, in a relative sense, that an equity market mutual fund should do really well, because we don't have any exposure to that falling market. But there is nothing to say that an equity market mutual fund should make money or lose money in either a rising or a falling market. It will purely come down to our stock selection and our ability to create value by the divergence between the long and short portfolios. And you can see on the next slide, how those two strategies have differed through the cycle. Apologies, I'll get this back to where I want it. Excuse me, folks. I just. So you can see this slide on 34. It's one that we publish in the ALF NTA update each month. And so ignoring the red and green box for a moment, you can see the yellow bold line there is ALF's net exposure through this period from 2007 through till today. And you can see there that the net exposure that we run in ALF is genuinely variable. We've had times through 2007, 2009 where the fund was fully invested. We obviously reduced that significantly through the GFC to protect the fund when the markets were falling. But as we saw markets recovering through 2009 onwards, that net exposure jumped back up to 100%, and we fully captured the recovery in the share market, and were able to add value through that period by being fully invested. But as that market cycle matured and as market valuations became more full, we've gradually reduced the net exposure of ALF to the point where, in late 2015, we're back to more or less neutral. Now, we can take that view and adopt those settings without compromising our ability to generate returns. You remember, in a market neutral setting, we still think that we can deliver mid to high single digit returns with no exposure to the market whatsoever. And so that was the natural evolution of the natural progression of ALF's net exposure through that period. But you can see that, through those periods in 2007 to 9 and 2010 to 12, ALF was fully invested. And then it's looked more like a market neutral fund, through the latter stage of this cycle. One of the things that Justin has alluded to in his part of the portfolio is, we are absolutely looking for an opportunity to get long and strong the share market if we see the right opportunity to do so. At this stage, we don't think that opportunity has presented itself just yet. We think we may get another bite of the cherry, perhaps later this year or next year, if markets sell off again. But ultimately, if we do see that next sell-off, we want to be in there at the bottom, getting net long the market and making sure that we are picking up that beta return that ALF and the absolute return fund are designed to do. And so I think it's an important point to make, because it seems to be one of the questions that keeps coming up in my conversations with shareholders is, what exactly are the differences? As we've said, for the last little while, the two funds have looked very similar, but there will come a time, and I think that time is approaching, where these two strategies will diverge again, and it'll be very clear the differing objectives that we have between those two funds. And so you can see on slide 35, again, this really, I think, captures quite nicely, what we're trying to do with each of these two strategies. With the absolute return or the directional funds, WARF and ALF, you can see here the performance of those funds across an average of all of the positive months for the market since inception. And you can see how the fund's gone in negative months in market. And you can see for ALF, in positive months, the fund is capturing about 2/3 of the market return. So we're able to, keep up, if not match, the performance of the market in those positive months. But in the negative months, you can see where that capital preservation focus kicks in. Our performance in negative months is less than 2/3 of what the market drawdown on average has been. And so that's clear what we're trying to do. We're trying to keep up with the market in up months and make sure that we're capturing beta where we think there's an opportunity to do so, and really make sure that we're protecting our investors in those negative months. What's that ended up as? The Australian Leaders Fund at a portfolio level since inception has outperformed the All Ordinaries Accumulation Index. With the market neutral strategy, on the other hand, you can see that the difference in the performance between the fund and the market is much more stark. We're certainly not capturing those very large gains in the market during positive months. Again, we're looking just to grind out an adequate return there. But you can really see, for our fund in particular, but this applies to market neutral funds in general, where the benefit will come, when the markets are having a more difficult time. On the average of all the down months for the market since the inception of the market neutral trust, our fund's actually gone up. And so that's an important and valuable feature of the market neutral fund. But it's, a distinction that I think oftentimes is not, as clear for investors to make, what are the two funds trying to do. And so just quickly touching on performance in the financial year to date, we were talking to shareholders for ALF and some of our investors in November last year at the AGM, very positive on the development in the business in 2019, and the prospect for an on-target performance year in financial year 2020. Getting to the end of the year, we were tracking 5%. We had another positive month in January. If you're thinking about that sort of that loose target that we've set for ourselves, around about 10 to 12% as a return objective for ALF, we were right on track to meet those return target. And importantly, it's also interesting to sort of drill down into to what the underlying portfolio settings were at that stage. We delivered for the financial year to the end of January, we delivered just over 6% return versus the share market at 8.3%. But our average net exposure throughout that period had been, very close to zero. And that exactly describes the task that, that we have for ourselves in that sort of market environment where, that the market's grinding higher. We need to try and keep up with the share market, and the key tool that we have to do that is through our stock selection. But we want to retain those cautious risk settings to make sure that the funds are protected if we get sideswiped by an unexpected development, which is exactly what happened in February when the coronavirus hit. So we were short going into the crisis. We were short because, to our minds, the market looked expensive and vulnerable to some sort of exogenous shock. I don't think, we could say that we imagined that the shock for markets would come in the form of that it did. But nevertheless, those settings stood the funds in good stead. Through February, or certainly through most of March, we were in positive territory. Unfortunately, we didn't end up with a positive result across those 2 months, principally because of some exposures in the travel and leisure sector. Again, these were stock-specific investment ideas that we had in the portfolio, and clearly those two sectors were two of the worst affected when the crisis came upon us. And also an overweight exposure in the small cap parts of the market, which again, if you think back to what happened through February and March, small and mid cap names, suffered much more heavily than their large cap peers. And so, whilst the portfolio settings at a big picture level were correct, some of these sector exposures and that size bias meant that we did suffer a small drawdown of about 3% in March. We did make some fairly significant changes to the portfolio settings through that period. We de-levered the portfolio substantially. So normally a sort of ambient level of gross exposure for us would be around 180 to 200%. Somewhere around $90 to $100 long and short for every $100 of capital that we have. That got down to as low as 70% in the peak of the crisis, and that's moving back towards 100% now. But that was one of the levers that we could pull to de-risk the portfolio. And then we've also very much tightened up on all the factor and sector exposures. Again, one of the features that Justin's touched upon in his presentation has been the wild swings between growth and value and momentum that we've been seeing in recent weeks. We want to make sure that the portfolio is fully insulated against those moves, which are proving very difficult to predict with any accuracy. The other big question that we've been getting from shareholders has obviously been around the discount to NTA, which the ALF share price has been performing or trading. It was a little bit disappointing for us to see in February and March that the share price did sell off, but I think it was understandable when people get nervous about things like global pandemics and the future of the global financial system. The selling tends to be indiscriminate across portfolios, and so we suffered along with most listed shares through that period, and the shares sold down. We've seen the shares slowly starting to recover, some of those losses in recent weeks. But there's a couple of important things to think about in terms of the discount. Firstly, you can see in the top panel of slide 38 the discount across the entire LIC/LIT sector, going back across the lifetime of Australian Leaders Fund. And clearly one of the observations there is that LICs in general have traded at discounts, and sometimes very large discounts for extended periods of time. Again, that was the case in February. We saw that the average discount across the whole sector blow out to 23%. Ironically, that average discount came back in again by the end of March, not because funds had recovered, but because fund managers were writing down the value of their NTAs to reflect the losses that they'd suffered in March, which meant that the discount between the NTA and their share price contracted. The ALF share price did sell down. Our discount did get out to around that 25%. Unfortunately, fortunately for our shareholders, the NTA was more or less stable through that period, but we're only just now seeing that discount start to creep back in again. The important point that I think we should note from these couple of charts here is that the LIC sector over time has traded a discount, but I think it's fair to say that it's only really been in the last few years that we've seen the breadth of strategies that are available through listed vehicles, start to increase. By far and away, the dominant strategy for LICs in that period between 2004 and 2013 was to be long only, and in fact, WMK, which is one of the listed funds that we delisted at the start of last year. It was one of the first hedge fund strategies that came to market in 2013, offering investors who preferred listed vehicles, a different proposition in terms of the risk and return. But I think the other point that strikes me when you look at how the LIC discounts have performed over time, when investors are looking for yield, or when investors are feeling less confident in their ability to be able to go out and generate attractive returns from their share portfolios themselves, we see interest in and demand for listed investment companies and listed investment products really start to increase. And so you can see there, through 2013, 14, 15, the average discount across all LICs, narrowed to the smallest that it had ever been. And I think, thinking about that period, it was a period for the market where returns were less certain. The outlook was cloudy. We'd been through a number of shocks in the European sovereign debt crisis, the end of the mining boom here in Australia. And also, there was a real question mark around, the banks and their ability to sustain dividends. And so investors were looking wherever they could for yield in a low yield environment. And I think LICs historically have been one of the areas of the market where investors have looked to secure, reliable franked dividends. For ALF was actually a period of very strong performance, but importantly, a period where our performance diverged very significantly from the performance of the share market, and it also coincided with a period of very strong dividends, which really are a function of performance for Australian Leaders Fund. And so, thinking about what some of the drivers are in that cycle of discounts and premiums for the broader sector, and for ALF in particular, the road ahead looks a lot more positive. We have a real opportunity here to distinguish ourselves from the market in terms of the return we're able to deliver, even if we see some of these challenges and risks that Justin's been talking about manifest. We feel very confident that with our return to form and with a clear line of sight on some of the trends that we're seeing starting to emerge, that we can be delivering very strong returns for our investors, and as a consequence of those strong returns, be able to sustain a dividend that will see ALF close that discount and hopefully in time even return to the premiums that we've seen from time to time in the life of the fund. So we've seen that discount starting to come in. We'd like to think that as we are able to put some more runs on the board in the weeks and months ahead, that we'll see that discount to continue to narrow. The board is clearly still focused on that, but there are a whole range of factors at play there, not the least of which is this secular question of the broader LIC market. Again, I think with more breadth and choice in the market now, we'll still see people start to distinguish between some of those old long-only funds, those dividend harvesting funds, and start to focus on which of those strategies will provide them defensive exposure in a difficult market. And again, ALF is one of very few that can provide that sort of profile. We've been very focused on capital management. Clearly, that was a big focus for us at the back end of last year. We've had an off-market buyback going now for a number of years. We've been amongst the most active in the market in buying back shares on market whilst they've been trading at a discount to NTA. And we'll continue to be active in that space where we see that it's adding value for shareholders. We completed the off-market buyback in March this year. We bought back 27 million shares with value of just under $30 million. The shares were bought back at a price that reflects the liquidated value of ALF's portfolio, and so I think that's an important point to keep in mind, particularly when thinking about discounts and what some of the considerations that the board might be going through are. The value of the liquidated value of ALF's portfolio today is about $1.05.5, which we've outlined in the recent NTA, and that's because there's a chunk of value there that is made up of tax losses accrued in prior years, and the way that we'll realise the value of those tax losses is by generating profits and offsetting those prior years' tax losses as we have taxable profits going forward. But certainly the off-market buyback, gave shareholders an opportunity to offload some of their stock at or around NTA, and that provided an accretion benefit of about 0.3 cents per share. The on-market buyback has been much more impactful in terms of the accretion benefits in this financial year. It's been $1.65 cents per share accretion to the NTA that we've been able to that's value that we've been able to add for the shareholders that remain. So that gives you a summary of what's been happening with ALF and in the listed investment space, and obviously hopefully some insight into some of the things that the board's been thinking about in terms of capital management. So that is the end of my part of the presentation. As Justin mentioned earlier, we have received a bunch of questions from investors over the last week or so. So what we might do, Justin, if you wanted to unmute your line again. And we'll just tackle these, alternating between the two of us, if you like. I'll kick off with you, Justin. We've talked about this briefly, but maybe if you just want to give your input on this. One of the key questions is, if a long-short strategy is all about capital preservation, how is it exactly that our funds are able to preserve capital?
Well, how are we able to preserve capital? So again, it's a fully hedged structure. So you effectively don't have any exposure to the stock market. What you're exposed to is our ability to add value through our stock selection. So again, if there's just two listed securities, Westpac and ANZ in the market, you're fully hedged, and we're long Westpac, short ANZ. You're fully hedged insofar as if the market of ANZ and Westpac go down or go up, then you don't have exposure to that. Our exposure is the degree to which Westpac does better than ANZ. So this is more of a spread business. We're picking stocks we like, that we think will outperform, that we're long, that we think will outperform stocks we don't like, which we sold, and we capture the difference in return. So it's much harder. So it's a pure alpha strategy in that regard. Fund managers get up every day to outperform their index to create alpha. And that's all you should pay for as an investor, the alpha the manager creates. But, we don't, in a fully hedged structure, when the settings are fully hedged, we don't capture the market return. So we got to create the value through our stock selection. We were right on track before the crisis to deliver the 10% that Tim talked to. The crisis has set us back. But we're confident we're making good progress, and we're not far from where we need to be to deliver that sort of return. But it's not easy. The average manager might deliver 2 to 3% of alpha a year in an ungeared structure. We use some gearing we look targeting more like 5 to 6, and then we gear that up to the 10 with an enlarged balance sheet. But it's not easy to create that much alpha. And we clearly haven't got there in recent years, but we feel confident we're getting closer and closer. But that's, it's harder, but then you have the benefit of the hedge insofar as, you're fully hedged from a crisis like we're seeing. So ALF, the value of ALF's portfolio is largely unchanged so far this year. The average portfolio has lost a lot. And so we protect you from that, but we've got to create the value through stock selection, and that's not easy. But we're making very good progress in getting to where we need to.
And there's just a question I can tackle this one on bank interest rates and whether in fact investors in our funds receive interest on cash holdings. I know it's one of the points that causes some confusion for some shareholders when we put out our monthly NTAs and they can see that, for example, the cash holdings of ALF are 100%, or it could be have been at times up to 110% of the fund's capital. That really is a function of the market neutral setting that we've held for the last little while. If the fund is fully invested, we look like any other long-only fund where we've got 100% of our capital invested in the market in all the companies that we like and we think will do well. But in a market neutral setting, all of that money actually sits in the bank, and then we separately go out and create the long and the short portfolios and fund those, from each other. So when we sell $100 worth of ANZ shares in the market, we raise short sale proceeds, and that $100 is what goes to fund the $100 worth of Westpac shares that we buy on the other side. And so we can still hold 100% of the fund's capital in cash in the bank earning interest while still retaining exposure to $200 worth of securities, both long and short. And so those interest rates, the returns that we get on the cash that the fund holds, which sits mostly in term deposits with an Australian bank, that all flows through to investors. Now, obviously, in this environment, that's a small number with rates as low as they are, and we also have to pay away a margin to the prime broker that lends us those securities to sell short. And so, what investors end up with is around about the cash rate on the cash holdings that the fund has. So hopefully that explains a little bit about how the cash works. Justin, one of the other questions was just on dividends, just casting back to 2017, 2018, where there was quite a substantial drop in the dividend that ALF was paying. Did you want to just walk investors through what happened there and where we've ended up?
Yeah, sure. And this really is an extension also of that prior discussion around the interest we receive on our capital. So when we're fully hedged, all our capital basically sits in the bank on term deposit. We have to pay a spread away to our prime broker. So we effectively get the RBA cash rate, which, as you know, at the moment is very low, less than 50 basis points. And so when we're fully hedged, that's all we get, 50 basis points. The dividends we receive in the longs get paid away to the owners of the shorts. And so the dividends just wash through our portfolio. So we don't actually receive dividends or retain dividends. They just get paid away on the shorts. What we get is the cash, the interest on the cash, which is, again, less than 50 basis points. And so that's the difference really between our strategy and the long only. If you've got a long only strategy and the market just goes sideways, which it has, I'm just looking at the chart now, the market's gone sideways now for 5 years since the beginning of 2015, and we've been fully hedged through most of that. Again, we got off the bus very early. We haven't been big believers in this propped up market, but it's flat now for 5 years since the first quarter of 2015. But the accumulation index has actually gone up, and the difference between the two is obviously the dividends. So, if you own shares and the market's flat over 5 years, you still get your dividends. So you still get a running yield of, let's call it 3.5% to 4%. Now, we don't get that running yield. We get 50 basis points. And so the difference actually between the two is the underperformance of the fund over the last couple of years, because we haven't created any value, and the market hasn't gone up. The market's been flat. The difference really in return is fully explained by the fact that we don't get a running yield. And that's the cost of being fully hedged. That's the risk you take when you're exposed to a market. Even if it doesn't go anywhere, you still get your dividend, you get your running yield, your 4.5%. But you're exposed to the market going down as it has, and may still fall in the months ahead. Who knows? But so that's an important difference. And so thinking about where our settings were through 14 and 15, when we had a lot more exposure to the market. Again, we were picking up that yield as well. And this is how most LICs pay their dividends. They basically accumulate all the dividends they receive in their long portfolio, and then they just distribute that as dividends to their shareholders. We don't get that. When we're fully hedged, all of our dividends we receive get paid away, and we're left with no dividends to distribute. We basically have to create our dividends through generating profits, and the profits come through our capital investments, capturing that spread, creating alpha. We pay tax, and that allows us to pay a franked dividend. But if we're not creating any alpha, then we can't pay dividends, and that's what's happened. So again, that's why it's much harder strategy. It's a pure alpha strategy. We don't get the running yield, the dividends, the free flow of dividends. But, the quid pro quo is we provide investors with a fully hedged structure. You don't have to worry about the value of your capital getting destroyed as the market falls. And you've seen that play out very clearly in recent months. And who knows what happens in the months ahead. But, personally, I think there's a lot of risk in these markets. And I feel very comfortable having all of my own money in these fully hedged funds. So hopefully that explains it. Again, when we have more exposure to the market, we pick up more of the dividends, and so we're able to distribute a higher dividend to our investors. But when we're fully hedged, again, our return expectations have got to be a lot lower. And so, again, it depends on how successful we are at creating profits. And we haven't in recent years for the reasons we've talked to. But we feel more confident we're on track to create the alpha we need to, the 10%, to pay a good return, to at least match the dividend yield of the market in the years ahead. But that's not guaranteed by any means. It depends on our success in creating value through our stock selection.
One of the questions we had this, obviously we've had this question in a number of forms, and hopefully we have touched on some of these issues already in the presentation, but clearly, one of the most common questions is, what can be done to repair the discount, and what will be the catalysts for ALF to trade closer to NTA. Just again, really setting out, where we see our case. There'll be a bunch of things that will have a significant impact on the discount. Performance is one, clearly. We need to be meeting those return objectives that we've set for ourselves, and hopefully, today you've got some sense of the strategies and ideas that we are using to try and get us to those targets. As a function of that, yield is another one. We've set a much more sustainable and achievable yield target for ALF. In the last couple of years, that we've said that we think we can match the yield on the Australian share market, and we think that's an achievable target, particularly as a function of meeting those performance targets. The other couple of issues I think, which will also be key, will be, when people start to realise that the easy money, the passive returns that they've been enjoying for the last couple of years aren't on offer anymore. And I think, it's still been a bit of a stalemate for a number of investors over the last couple of months to start making those decisions about whether they reallocate their capital into more defensive strategies. If you think about, the financial markets, across the world and here in Australia, by far and away, the sector is dominated by strategies and products that make money from rising asset prices. And really, the degree to which they make that money, depends on sort of how aggressively they try and outperform these passive asset price returns. That was clearly called into question in February and March. And then again, we've seen that the markets bounce back very rapidly in April and May. And so I think, for a lot of investors, it's a conundrum. Do I get defensive now, or do I wait and see how this plays out? I think as time goes by and as people realise that those passive returns, are not going to get them the portfolio outcomes that they're looking for, we'll start to see interest increase and money come back for more defensive strategies that do offer that downside protection, strategies that can deliver returns independent of rising asset prices. And I think, that's when we'll start to see, some differentiation within the LIC sector. So strategies like ALF will obviously, be on the table then. And I think that will be a clear catalyst for, the discount narrowing, like we did see, back in 2013, 14, 15, when we were looking at similar, a similar proposition for investing in terms of where they allocate their capital. I don't know if you've got anything to add there, Justin.
No, I don't actually. No, I think that's a good summary. Thanks, Tim.
Just a couple on markets. We had one on the oil and energy sector. Justin, I'm not sure if you wanted to make any additional comments to what you mentioned before, particularly the Australian oil producers Santos and Woodside. Obviously oil's been one of the big sort of stories over the last few months. A rapid decline in the oil price and negative oil prices there for a little while. Just maybe a quick synopsis of where you see the global, the global oil industry and what the prospects might be for some of our local producers.
Excellent. Thanks, Tim. I mean, oil was different to other commodities insofar as the demand from advanced economies is much more important than in other commodities. Say iron ore as an example, China represents over 50% of the world's demand. But in oil, in terms of oil demand, China would be, I think, closer to 20%. And that's because China's building bridges and dams and roads. And so, these metals and bulk commodities are much more aligned with countries that are engaged at the earliest stages of their development, whereas oil is more of an advanced, again more exposed to advanced economies where you have transport fleets and the like. So oil was far more exposed to this crisis than other commodities, and then because there's limited storage for oil, the various pipeline hubs like Cushing and so forth, the fleet of tankers on the high seas, then as the inventories fill, then the price has to fall very quickly. And we saw the unusual example in recent weeks where the spot price actually was negative on maturing contracts for I think it was only over a day, a couple of hours in one day, but it actually went negative, which has never happened before. And so what do we need to see? We need to see some significant supply side adjustment to rebalance the oil market, and OPEC have done their bit definitely there, but they could do more. And the cooperation between Russia and the other OPEC members, is somewhat tenuous. But it became very clear back in March that they weren't going to be able to control the market or keep the market balanced, given the demand shock that they were seeing. And so prices collapsed in March. And so, these lower prices, there are a lot of the US onshore production in particular is uneconomic. So you're going to see a lot of well closures there. Again, a lot of the the high cost deep water production is uneconomic as well. So you do need to see a lot of closures before the oil price can firm up and move back to balance. So until that happens, the oil price is probably going to be weak for some time. The added complication for the Australian companies that are more exposed to the LNG sector is the weakness we're seeing in the LNG price. And so the prospects for growth in LNG, I think, are much diminished now, given where the oil price is. Woodside and Santos had ambitions for, additional LNG projects. I think like Scarborough for Woodside in particular, I think those projects, Browse, I think those projects now are highly unlikely. In fact, in the case of Woodside, they're talking about potentially having to shut in one of the Northwest Shelf trains. So there's a lot of adjustments still to take place in the oil patch, LNG in particular. But you can forget about growth. There's very little growth, I think, to occur in that space for years to come. So, I think I'd be very cautious on the oil names. You've had a good rally now. If they retest those lows, then maybe you look at them again. But right now, I think, again, with the rally that we've seen in those oil names, I think it pays to be cautious.
Maybe one more, Justin, for you. This is a sort of two-part question. The first part is on the currency wars that are going on at the moment. The question was specifically looking at, depreciation of the renminbi against the US and the impact that would have on the trade position between US and China, but I guess more broadly currency and specifically countries' devaluation of their currencies is a big theme at the moment. Have you got any comments on that?
Yeah, sure. I suppose one important change in our process in recent times, is really tempering our views around topics that we're not experts at, and I probably wouldn't have a greater insight into what's going to happen with the renminbi than anyone else, and trying to pick currency trends, I think, is fraught with danger. Having said that, the US dollar is clearly in a downtrend. There's a clear 10-year cycle there. The dollar's been strong now for the last 4 or 5 years. It's clearly rolling. And the US dollar tends to be the other side of the capital flows in and out of the US. So through this crisis, money was sheltering in the US economy and supporting the US dollar. Now, as the global economy recovers, capital is now leaving the US and moving into emerging markets in Europe, and you can see that in the strength in emerging markets. The emerging markets have been very strong, and the commodity currencies have been very strong, like the Australian dollar. Again, the Australian dollar is interesting, which is really the other side of that. We've been pushing up against 70 cents now in recent weeks. That's going to be an important milestone, but again, it's risk on. The commodities and deep cyclicals are all being bid for, and our currency has been caught up in that. So it's going to be interesting to see if the Australian dollar can break through 70 cents. Got down as low as 56 cents. But I think that's going to be an important milestone. And I think, again, we're seeing this pause at the moment in this cyclical rally. I think everyone's just waiting now to see what happens with the data in the weeks ahead before they keep pursuing these cyclical sectors and pushing them to new highs. And you should think of the Australian dollar that way as well. If the dollar breaks through 70 cents, then it's just game on. You're looking at Europe moving a lot higher. You're looking at all these commodity sectors doing a lot better. And clearly the cyclical recovery continues. Right now, though, we're seeing a pause, and you're seeing that reflected in the Australian dollar as well.
There's actually interesting. The second part of that question, I think, might even be an extension of that discussion, which is what you think the degree to which quant funds and systematic trading is impacting those trends, and specifically for the share market, what sort of trends you're seeing that might be a result of the sort of rise of quant funds and ETFs for that matter.
Mm-hmm. Well, I'm not sure how the quant models are going. We spend most of our day focusing on getting our model right. You have touched on an important point. These factors really are driving this market, and they can really be tied back to these macroeconomic indicators that we've talked to. We walked you through what's going on in the bond market in terms of the strength in growth. Cyclicals really are tied, obviously, to the strength of the recovery and the confidence that investors have in the recovery. The rally was seen in value in recent weeks, and banks are obviously the key part of that equation. Really was a reflex response to growth being overbid. So, all the tech companies were just really expensive. And at the same time, a lot of the value sector was really at a low ebb, plumbing new lows. The Australian banks were a good example of that. And that elastic band had just stretched as far as it could. And then the bonds started to sell off, the yields started to increase. And that was the signal to rotate into value. And the banks ripped in a couple of sessions. These are the kind of signals that we spend a lot of time trying to understand now. We have a very clear framework where we look at all these macro signals and how they play out in their factors. And we manage that very tightly in our portfolio settings to ensure that we're at least on the right side of the moves. We don't want to be fighting these factors, but we spend a lot of time trying to work out these trends. And really, you don't have to be able to forecast the future. You just got to be able to interpret the price signals and work out what's going on. And that's what we spend most of our time trying to do. We're not trying to work out what's going on in China with the renminbi or Chinese policy, or and the US and the ground in the cities with the health crisis. There's too many uncertainties around trying to figure those things out. We're better off just watching the price signals and ensuring we're on the right side of the moves. And that's how we interpret these trends and make sure we're on the right side of them. So we're taking you through the growth piece, the cyclical piece again. We're at a pause here. We need to see how the data plays out. Whether investors are confident enough to chase these cyclical parts of the market. They need to be confident in the recovery to do that, because we're not far off prior highs. So to get back to prior highs and push the market higher, you need the cyclical parts of the market to participate. And I don't think anyone's really that confident at the moment in the outlook. So that's kind of just walking you through the different factors and how we look at them. And again, the macro settings, the currencies, the bonds, the risk, the rates, and the risk indicators, we're all tied up in that, obviously. So we follow them more closely, try and work out how that plays out into the factors, and then how that plays out in the Australian share market. So it's complex. It's not, and it's moving. They're all moving around like a wild snake at the moment. But at least we're reading it very well. But then you need to execute with your portfolio, and that's not easy either. And so, as a general overview, we haven't been big believers in this recovery, in this rally. It's all basically been pumped up by liquidity support from central banks. It's the easiest way to think about that. The US Federal Reserve has pumped $3 trillion worth of new money into the securities market, buying all manner of securities, everything except for equities. And the value of the US share market has gone up by $3 trillion by the same amount. So you kind of see how the liquidity just moved into the risk assets, and no one's going to get in front of that. That's the problem. And so no one believes in this rally. But unfortunately, everyone has learnt to believe in it. They have to, because you just can't get in front of that scale of liquidity. It just keeps pushing the market higher. And then the other problem was the positioning. Everyone was short. Everyone was a bear. And so, until that positioning has balanced out, and we're much closer to that now, and until that liquidity tap's turned off or turned down, then the natural tendency was for the market to move higher. And so the market's been moving higher really on technical issues. The actual outlook is as bad as it ever has been. I wouldn't say the disease progression probably hasn't been as bad as expected, but the state of the global economy is as worse as feared. And so the fundamentals, there's been a big separation here between Main Street and Wall Street. And, the separation has probably never been bigger. That's where we are today. So we follow all this very closely. We haven't been big believers in the strength of this rally. We still think it's a bear market rally. And so, we're looking for an opportunity to sell it. but it just keeps squeezing higher. Every time we do, it squeezes higher, and that costs us a little bit of money. And so, we're trying to really limit those losses, but, it has cost us money in recent months. We've had some hedging in place, looking for this rally to run out of steam, but so far it hasn't. So, we'll keep trying, and we try and limit contain those, the cost of that insurance. But it's not easy. It's certainly not easy to manage a portfolio in this environment.
Well, Justin, I think that might be a good point to call it. So just finally, thank you to everybody who's joined the meeting today. We have missed getting out there around the grounds, seeing people in person, and we'll certainly be looking to try and get around the country later in the year, hopefully, as we would normally do, assuming that all of the lockdown restrictions and so forth have been lifted. But we do thank you for your attention and for your support and for your questions. We've in lieu of being out there seeing people in person, we've been trying to talk to as many of our investors and shareholders as we can through these recent months, and we do encourage you to give us a call if you've got any further questions or concerns. We're always happy to chat. But for today, we might call it there. If you weren't able to get a copy of the slides by email, they're also available for download on our website, and we've lodged a copy with the ASX as well. So you should be able to find copies of the presentation there. Now, if you've got any other final remarks, Justin, otherwise we might call it.
No, thanks everyone. We really appreciate your support. And again, there's a long way to go in this crisis. If we can get on the right side of a few of these trends, then hopefully we can deliver some good returns for our investors. Thanks everyone for your attendance today.